In 1720, a single company's stock price rose 1,000% in months. Then everyone who bought it lost everything. London, September 1711. The South Sea Company was founded with a simple premise: trade with Spanish America. The British government had war debt. The company offered a deal: take the debt off the Crown's books, convert it to company shares, and profit from colonial commerce. No one involved had actually secured trading rights with Spain. That detail would matter later. For nearly a decade, the company sat dormant, a minor footnote in British finance. Then, in 1719, Parliament passed a law. The South Sea Company would assume even more national debt. The government sweetened the offer. The company could issue new stock to cover the debt transfer. The math seemed elegant. It wasn't. John Blunt ran the company. He was a financier with ambition and no scruples. He saw an opportunity. If he could convince enough people that the company would become fabulously wealthy, that trade with the Spanish colonies would be enormous, stock prices would rise. Rising prices meant more people would buy. More buyers meant higher prices. The cycle fed itself. January 1720. The South Sea Company's stock began to climb. It opened the year at £128 per share, nothing unusual. The company started buying back its own stock at inflated prices, a trick to create artificial demand. Blunt and his associates also bought heavily. They knew what was coming. Word spread: a company about to monopolize trade with the richest colonies in the world. Fortunes would be made. Everyone from nobility to servants wanted in. The stock hit £200 in March. Then £300. The company issued new shares at higher prices. Each new offering sold instantly. By April, the price had doubled again. £600. Clerks, widows, farmers, ordinary people mortgaged everything. They took loans against property to buy shares. A serving maid in London heard she could become wealthy. She scraped together her savings. A country vicar in Yorkshire did the same. They didn't know yet that the company had no actual revenue. Not a penny from trade. June 1720. The stock hit £1,000 per share, a tenfold increase in 5 months. Blunt and the directors sold. Quietly, methodically, they converted their holdings to cash. They knew what the numbers meant. There was no way the company could ever earn enough to justify these prices, but they needed the bubble to hold just long enough to escape. Rival companies emerged. The Sword Blade Company, the Casket Company, dozens of others, all promising impossible returns, all equally fraudulent, all selling stock as fast as they could issue it. The fever spread beyond finance. A company was formed to extract oil from sunflower seeds, another to develop perpetual motion. Rational people abandoned reason. July arrived. The South Sea stock reached its peak, £1,050 per share. At this valuation, the company was worth more than all of England's land, more than every estate, every farm, every building in the kingdom. The price had become detached from any possible reality. The insiders knew they were already gone. August 1720. The first crack appeared, not from within the company, from without. People began asking questions. Where were the profits? When would dividends actually be paid? Rumors started. The company had no real contracts with Spain. The trade routes didn't exist. The directors were selling their shares. Selling began, slow at first, then frantic. Everyone who'd bought at £900 wanted to sell at £800. Everyone who'd bought at £800 wanted to sell at £700. The price collapsed like ice in spring. By September, it was £400. By October, £200. By December, £50. Fortunes evaporated in weeks. The serving maid lost everything. The vicar lost everything. Thousands did. Some took their own lives. Others simply disappeared into destitution. A woman who'd invested her late husband's inheritance was found begging in the streets 6 months later. These weren't abstract losses. They were lives unmade. Parliament launched an investigation. Directors were arrested. Blunt was found guilty of fraud. His estates were seized, but the Crown's debt remained. The government had transferred its obligations to the company. Now those obligations were worthless. The nation's finances were in chaos. The consequences rippled outward. Credit dried up. Banks failed. Trade slowed. England's economy contracted for years. The South Sea bubble didn't sink the empire, but it nearly did. A single speculative frenzy, fueled by lies and greed, had nearly collapsed the world's rising financial power. What made the bubble possible? The mechanism was simple. A company with no earnings, directors who lied about prospects, ordinary people desperate to get rich, and a market with no regulations, no transparency, no truth-telling requirements. Sound familiar? After 1720, Parliament passed laws, rules about corporate disclosure, restrictions on stock manipulation, regulations on new companies. The South Sea bubble was so catastrophic that it forced the creation of financial oversight. It took destroying a nation's economy to build the guardrails that would prevent the next one. But here's what's worth remembering. The bubble didn't surprise everyone. The insiders saw it. They knew the prices were insane. They sold while others were buying. The people who lost everything were the ones who arrived late, the ones who believed the story just as it was ending. That gap between what insiders know and what outsiders believe, it's the same gap that opens before every crash. The South Sea Company itself survived. Stripped of its grand pretensions, it became a boring financial institution. Blunt died in prison, his fortune confiscated. The directors faced public disgrace, but the damage was done. Thousands of ordinary people learned a lesson that no amount of regulation could fully prevent. Desperation makes people believe what they want to believe. Subscribe. Every week we uncover the mechanisms behind financial collapse, the people who saw it coming and the ones who didn't.